Hey, hi everyone, and welcome to the BGL monthly webinar for October 2023. I'm head of Simple Fund 360, Jeevan Toki. So like most of our webinars, today's session will be recorded. So if you do miss out on any section or need to review the recording, it will be available on our YouTube channel. All attendees will receive a link to today's recording as we go through. Any questions that you do have, please enter it there into the Q&A panel. We've got a whole bunch of different BGL team members who are dialed in ready to answer questions, and then we'll regroup with Q&A at the end. So for the first section, I will take you through the BGL update. So what's actually changed within Simple Fund 360 and Simple Invest 360. I'm then joined by Aaron Dunn, CEO and co-founder of Smarter SMSF. So welcome, Aaron.
Thanks, Jeevan. Great to be here once again.
Thank you. So Aaron will be giving us a update on the hot topic of the Division 296 or the $3 million super tax.
Yes, we've got a name for it now, so we'll go through the exposure draft that's been released.
Perfect. And then, as mentioned, Aaron and myself, will cover Q&A there at the end and cover any questions that you do have. Okay, so let's just jump into it. So I'll cover the last two updates that's released. So one on the 27th of September, and the other one there on the 19th of October. Okay, so the first change here is around Smart Docs. So obviously we continue to increase the number of documents that we are supported. So now in terms of smart matching, we do support obviously distribution statements. Where you are matching and using a dividend statement to a document to actually match a statement, it will now extract LIC deductions from those statements. And we also support foreign dividends from those particular statements as well, and use that for smart matching. So where the transactions have already been coded or matched, and those dividend slips or distribution statements have been imported, they will be automatically attached to the transaction where there is a match as well. And just a reminder, obviously, I won't cover in this particular update, but obviously in a prior release, we released the ability to import annual tax statements. So you can extract those. If you'd like to see how they are covered, just to have a view of our previous recordings. Okay, so next feature up around property valuations. So it's a new supplier there that we have integrated, which is Valuations. So as you can see there on screen, they support valuations there for residential, commercial, rural and agribusiness across Australia. So you'll find that within either the security screen or the properties console. So let's have a just quick look at that. So I'll go and select my particular fund. And then I'll go across the investment menu to property dashboard. Okay, so we've now made a change. Where you will see all the external providers listed there on that button, external service providers. So if we click on that one, you'll see all the valuation providers there grouped together. So you'll see the various ones that we do connect to. So we've got Valuations there that we do provide, and we've obviously got the loan provider there, Compare and Save. So we are looking for a fifth provider sometime soon. We've just signed the contract with them, which is CRBE, and I think that'll bring to a close. But we've tried to give you obviously breadth of choice there, and you'll have the ability to connect through. So if you do have, these third parties obviously they're a third party. So if you are finding the service is lacking in one, or you're not happy with the process, please let us know, and we can actually at least pass that feedback on to those providers and hopefully get some change there. We have received a lot of feedback around CoreLogic in the past 6 months, which is hence why we're increasing the number of valuation providers that you see there. Okay, so next one up is new security screen. So what we've done at the moment is, in terms of UI, is taking a lot of feedback from users, and also trying to, I suppose, enhance some of the functionality which is available there as we move forward. So let's jump across there into the new screen. Oops. Okay, so if I go across there, so the previous old screens found the investment security list, so we'll keep that for a little bit until we're satisfied that the new investment security screen will meet all the current conditions as we go through. So with a couple of different things, I guess, with the look and feel. So the previous screen was broken into really exchanges or group the actual by the various security types and the like, I guess, or market types. So with the new one, it's designed to be really a global sort of view, so it's not tied by column. So that advantage is you can actually search for a particular code. I'm just going to BHP, which is an easy one, and it will search globally across all the different exchanges. Obviously, this one's going to be ASX listed and Bitcoin. So at the moment, we know there's a bit of slowness in some of the search with that too. So we're looking to speed that up and improve it. And go through and find, but it'll go through and actually search for the word BHP that's contained in every single one, and you can find that across the board there. So that it means you don't have to select the market type first up. Okay, the default view, as you can see here, will actually show all the securities held based on that latest date they go through. So you could change that to say financial year end date. What you can see with a very quick view is the balance at that particular date and the actual code. So you can actually see which ones have a unit price or not. So the advantage of that, let's actually go back to maybe a custom one, which we go back to in the previous year. Is if you're, especially around year end, where you do have either private investments or the likes of, say, real estate, you can actually see which ones don't have an updated price or the latest price and go through and view those. And the same can be utilized there for audit purposes for those. This was a new report which was added earlier this year, was the unit prices report. So this is great in terms of providing to the auditor their year end. So this can be generated here from this screen or the actual report screen as well. And this, for the same purpose, will actually show as at the particular date what price was being used, what was the price type, was it the system price, custom price, is it X distribution or not, and the actual price being used. So that's great from the audit perspective, and a lot of the auditors' feedback that we've had is that they do love that report there. The next key change we've added into there is the ability to add in asset allocation. So previously this was only allowed to be entered in automatically by BGO on a system basis. So you now have got the ability to either add in the asset allocation, so especially for likes of, say, a property. We go back to financial year end date. Let's say, for example, for a property where you can add in an asset allocation, let's say, especially for here, you could go in and put in, obviously, 100% it's going to be direct property and put in the particular date, and that obviously for others we'll go through with that, and in the future stage we'll look to expand these categories, but at the moment they're still on those default categories. So those obviously custom asset allocation due is used for the investment strategy comparison reports, and also across some of the investment reports at this point in time. But where you are looking up the security list, try and use the new screen rather than the old one. Let us know any feedback or where any other improvements can be made. Okay, so for Division 7A loans, so obviously that we released several months ago now. So now you can post transactions as part of the period compliance report. And we've also added Div 7A training there with a group called Tax Nuggets. So if I jump now across into, the Div 7A screen. Again, all the features of the particular, I won't go through in detail, but just we did cover in a previous webinars, but for anyone unfamiliar, this allows for any companies or trusts within Simple Invest for you to actually track all the particulars of the Div 7A loan, calculate the minimum interest repayments, process through all the transactions, process unfranked dividends, where you're posting that as a dividend, and you'll have the ability to even export that as an Excel worksheet for your own internal working papers there as well. But it's a great tracking tool. Obviously, Div 7A can be complex. So we've partnered there with Tax Nuggets, where you get to, do have the ability to utilize their training services at a discounted rate with there. So you can obviously click through, which will take you through into their dashboard and allow you to obviously look at any of the Div 7A training that they do offer there. Okay, Tax Nuggets do provide a mixture of some free courses and some paid courses, but I guess feel free to have a look and chat to the team about how that meets your particular firm's requirements. Okay, so next one there is workflow. So jumping across there, it's in Simplify 360. So this is something we've had in a beta phase for several months now, and as you might be aware, we've now released it to all particular clients with that. So how this screen came about is what we found is, especially from a lot of accounting firms, is a lot of their workflow or job tracking was done using a combination of their practice management software. So it might be something like XPM. And then they would also, for their SMSFs in particular, they would then utilize individual sort of or more detailed job tracking within an Excel spreadsheet. So the purpose of this screen really is to get rid of that Excel spreadsheet and be able to track jobs, ad hoc tasks, and the likes here directly within Simplify 360. So you'll find obviously that under workflow. So if we go through the particulars, so first of all, going down here into the workflow overview, we'll provide, I think, 4 or 5 standard system job templates, and you've got the ability to either customize those or add your own in as you do go along. So you do have the ability then for each job particular template is to go through, add in all the particulars that you'd like. And then what we're starting to incorporate is not just the individual tasks, is then also triggers to automatically mark those as complete when they have been done. So an example here might be when the is to complete this task of lodge annual return automatically when we receive a lodgement has been completed for the fund. So it's not just manual updating of jobs and tasks, is that where we can automate the completion because the task has been done outside on another screen, that we can automatically do that. So another example might be work papers, where the work paper status changes, we could automatically update that as well. So look out for that as we do go across. Templates you're able to add obviously in bulk across various, let's say, various super funds and the like. So I'll just add this to a couple now. In bulk, and you can put in the start date, due date, anything like that. So as we do go through. Okay, and then for the actual jobs and workflows we go through, there's a couple of different views. So first it was just a entities view, which will just show a list of all the entities that you do have, and then any jobs that might be assigned to those. So you can actually see the underlying tasks. The other one here is the jobs view. So the jobs view, as the name describes, will show all the different jobs, showing notifications and anything it might be. When you come in, you can actually see, for example, any jobs or tasks that are assigned to yourself. You can actually go through and have a look at those particular ones. If I go through into this one here, again, as things are marked off, it's automatically tracked and done, I guess, there accordingly. Things like comments and documents can be attached to the individual job as we do go through there as well. And there's various filters that you can view. I just removed that one out as we go through. You can also export that entire list of jobs and tracking out to CSV if you need to load or analyze them into a different system as we go through. Our next phase, what we're going through with this, is the ability to add in more system triggers. We are looking to also be able to sync this with practice management systems. So that you do, where you are utilizing a cloud-based practice management system, that these jobs can sync back and forth there as well. And then obviously, and then also I think the extent will be going into some nice management dashboards and the likes. So as you can see here, you've got the ability there to, I guess, filter and whatnot as well. And as we go backwards there, obviously you've got some key features like there, we're being able to bulk reassign. So let's say where someone's on annual leave or potentially left the firm, you can go through and obviously easily replace all their outstanding jobs automatically there. So again, have a go at it as where time permits, and utilize that. Any questions or feedback that you do have, please let obviously the team know there through the feedback button. Cool. So they're the main features that I'm going to show today. So I'll pass over to Aaron for the second section there.
Excellent. Thank you, Jeevan.
So Aaron, I've just given you control.
Perfect. Excellent. Thank you. Well, I think, Jeevan, as you stated earlier, the big news, obviously, this month has been the government releasing what we now know as Division 296. So this is where the government had previously announced this additional tax that would be imposed on individuals who have balances that exceed $3 million. I'll give you some context first up in terms of where this is at. Quite clearly, there's been a level of frustration, in particular, that Treasury had only really given us a 2-week consultation period for this, which naturally has been insufficient. There's been a lot of long hours within the industry, and naturally, the way in which this law has been drafted from an SMSF context, in essence, there are a number of technical problems with the draft laws, and a lot of that has naturally been aired through some submissions that have now started to be aired from across the industry. What I can tell you is that there has been some further consultation with Treasury, and naturally in Canberra there's some discussions happening with the crossbench senators as well, and that's kind of where, if there's going to be any change, that's potentially the avenue that's going to have to take path to get the actual changes that may or may not eventuate. And still, the result from when this was announced and the fact sheets and information that came about, we haven't seen a great deal of change in respect to this exposure draft. So all of the concerns that were previously raised still stand, and that includes naturally the inclusion of the unrealized capital gains, because we're looking at total superannuation balance as a concept, and the fact that the threshold at $3 million doesn't index as well. And so I've included a link there if you want to go and find out more in respect to the consultation process. So let's, there I am. Sorry, I went one too many. Okay, so let's kind of work through here to help you understand how these measures are going to apply. And there is some new terminology that forms part of this exposure draft that is important for you to start to understand, because a person here has taxable superannuation earnings for an income year if their total superannuation balance at the end of that year is greater than what we call the lower balance, super balance threshold. So i.e. the $3 million amount. And as a result of that, the amount of their superannuation earnings for that year is greater than nil. And I'll come back to that concept of greater than nil, because that will impact whether you have earnings that are subject to the Div 296 calculation, or ultimately you have losses that will then be able to be carried forward and applied in subsequent years. So we have 3 steps to this process, and those 3 steps are: 1, the calculation of our taxable superannuation earnings. We need to work out that percentage, and we look at it in the context of the TSB at the end of the year, and it does become an adjusted TSB. And again, I'll touch on that shortly. We have our low super balance threshold, which is in essence our $3 million amount. So if you have an amount that is below $3 million at the start of the year and it grows up, then we need to use the $3 million concept as a floor and a ceiling for the purposes of the calculation each and every year. And we then look at a proportionate calculation by dividing that TSB at the end of the year and multiplying it by 100. So once we get our percentage of our taxable superannuation earnings there, we then multiply it by the amount of actual superannuation earnings for that particular year. And then our tax liability comes off the back of that particular proportion. Now, it is worth noting that that percentage that we get is rounded to 2 decimal places as part of that process. So we then come back to a revised terminology that is going to now occur in the concept of our total superannuation balance. And the concept of TSB is actually central to the scope of how this works. Okay, so we need to look at it in the context of our opening and closing balance. But what we will see throughout this process is an adjusted closing balance, because we need to factor in adjustments by withdrawal and contributions. And I'm going to touch on those in the next couple of slides. So what we will see out of these laws is the introduction of a new concept, and that new concept is a total superannuation balanced value. When we look at total superannuation balance historically, because of things like defined benefits, we needed to go through, and in respect to retirement phase value in particular, we needed to look at an individual's transfer balance account and then make all the adjustments by virtue of add backs and subtractions of the various debits and credits, and then come to a market value, in essence, or current value, to determine what that retirement phase value was. So what we're going to see here is a decoupling of the transfer balance account from the concept of total superannuation balance, because of the fact that we need to be looking at value each and every year. And therefore, we are simply looking at the individual's withdrawal balance, or the balance as if they were to cease that interest in the superannuation fund at that point in time. Okay, so from an SMSF context, not a significant change, but just a change worth noting, because we are still looking at the withdrawal value, but we don't need to go through that kind of convoluted calculation of making the adjustments back off the retirement phase value because of that linking to the TBA. Now, what is important to note in terms of these amendments is that it doesn't change the treatment of structured settlement contributions. There is somewhat of a level of frustration within the industry that we have a different set of rules for structured settlement contributions, insofar that they're not included in this calculation. Yet, if you have a total and permanent disablement policy that matures inside the fund as a result of an incapacity issue of an individual, then there is an adjustment that gets made there. So these sort of things have been pushed back to government. Whether we see them address these issues, we'll need to wait and see. And the other thing that we do see specifically for Div 296 tax is the TSB value will disregard LRBA amounts that are required to be added back for TSB purposes. So under the TSB rules, ordinarily, when we're thinking about making non-concessional contributions and so forth, any post 1 July 2018 arrangement that has been entered into, where it is either A, related party loan, or B, the member has actually met a condition of release, then with a nil cashing restriction, then in those circumstances, there would need to be an add back of the value of the LRBA for TSB purposes. That doesn't occur in this context of TSB value. We simply ignore that add back because we need to be looking at the net value here in the context of the calculation for Division 296. So then when we look to this next step of calculating the superannuation earnings, we have this basic superannuation earnings calculation, which is in essence the adjusted TSB at the end of the financial year, needs to be deducted off the total superannuation balance of that member at the immediate preceding financial year. So we have two different calculations here of how the TSB needs to be looked at the end of the year versus the value at the start of the year as part of this calculation. So then it becomes, well, what is an individual's adjusted total superannuation balance? This is, in essence, the TSB at the closing balance, as we've ordinarily known, but then we need to adjust for a range of withdrawals and contributions, which in the eyes of Treasury would otherwise either overstate or understate the investment earnings that have been generated during that year. So you can see on this page, we have a number of items that in essence, we would need to adjust for or add back in the calculation for the purposes of this adjusted TSB. So if we had our adjusted calculation, we're going to need to add back as part of that process any super benefit payments. So pension payments, lump sum withdrawals that occur, If there's a contribution splitting amount that's paid to a spouse, then we need to add that back. And as you will see shortly, that adjustment would need to be deducted as part of the contributions piece. And there are a number of other things that you can see in there. Now, what isn't included in that withdrawals adjustment is any rollover amounts, any payments made under continuous disability policies, so temporary incapacity, for example, and amounts that arise under any fraudulent or dishonesty and payments of unclaimed superannuation benefits. So that's one part. So this is where we require the withdrawals from an add back point of view. And then we need to deduct off in that year things like the various contributions. So contributions made to an individual super plan. So we're looking specifically at 88%, 85%, I should say, of any concessional contribution amount. There may be some circumstances where we need to adjust back non-concessional contributions. You're probably saying, Aaron, how can you have non-concessional contributions for individuals that have balances above $3 million? Well, there are some. If you think about a downsizer contribution that does not qualify as a downsizer, automatically becomes a non-concessional contribution. So from that point of view, whilst the limit is 0 to be able to make NCCs, you still do have a non-concessional contribution. The same goes with concessional if no deduction is eligible to be claimed. So those sort of things we still need to adjust. The family law splitting, the contribution splitting is the other side of the coin there. TSB value for superannuation death benefits when an individual becomes a retirement phase recipient. So if we're thinking about reversionary pensions there, so there is a credit or timing credit for that death benefit payment that is assigned to that individual, whether it's reversionary or non-reversionary, TPD, and a range of other items that you can see there. So then once we kind of make that adjustment, we need to then determine whether the result of that, so the concept of basic superannuation earnings, are greater than or less than 0. And on the basis that we end up in a negative figure, then there is an entitlement under this Division 296 to enable that loss to, in essence, be carried forward. Okay, so once we adjust that and we come up with a result that is less than nil, we create a transferable negative earnings amount. And that unapplied transfer negative earnings amount, which ultimately is going to be expressed as a positive, as a carry forward item, can then be deducted from that basic superannuation earnings calculation that occurs each and every year until such a time that that carry forward amount is fully utilized. So if the individual dies, it should be noted, and they have a carry forward amount, that amount dies with them. There is no assignment of that to tax-dependent beneficiary. So it was a husband and wife situation and the pension might have reverted across. It doesn't mean that any of those unused items can as well. And again, there are a range of examples within the explanatory memorandum that you can go and have a look at further to try and understand how these laws work. So once we get through that process, and there's going to be a lot of discussion, I guess is probably the right word, around trying to determine that value every year. And we know within the context of a member's total superannuation balance and that termination date that we can look at how that balance is created. If we think about tax provisions, if we think about other costs that we might want to include within that calculation for the purposes of an individual's TSB, because in the SMSF annual return, we can not only, or we can report not only on account balance, but we can report on TSB value, which can be a different figure in the return as well. So the other part here is what then happens in the context of the assessment and then the liability. So what is important to note here, because it is talked a lot about the fact that it's a 30% tax. Yes, it is in essence, but it's a liability that is assessed to the individual. Okay, so the first thing to note here is this runs in parallel to how we understand the laws applying for Division 293 tax. That is where we have an additional 15% tax on contributions where an individual has income above $250,000 for the year. So this is a liability that in the first instance is raised against the individual. It is not a super fund liability. Okay. Now, the only exceptions to Div 296 tax not being raised to an individual is either A, where there is a child pension that is being paid. So therefore, because the fact that we have a prescribed timeline to age 25, and then the money must come out, the government has indicated that they're not looking to apply Div 296 to those circumstances. Where we have individuals that have a structured settlement contribution made in respect to them. I touched on that earlier, and the concerns that have been raised within the industry around the differences between, in essence, having policies outside of super and inside of super, and then individuals who have died before the last day of the income year. So in essence, what that means is if someone passes away, until such a time that that death benefit has been dealt with, there's going to be no issuing of Division 296 in respect to that individual. And in my view, this does change the landscape even a little bit further around what you might be thinking with reversionary and non-reversionary pensions. And therefore, there might be some work to be looking at with some of your higher balance clients about maybe changing those that were reversionary into non-reversionary in the context of some of these particular rules that are being introduced. And then once we get to this Div 296 tax that is payable, we do have a time frame of up to 84 days after the Commissioner has issued that notice of assessment for tax. There are different rules, obviously, for defined benefit interest, the fact that that can't be accessed until a later point in time. And any amendments to that assessment would actually provide an additional 84 days after that Div 296 tax assessment has been raised at that point in time. So that is acknowledging, and Treasury has said it within the explanatory memorandum, they need to naturally give some of these funds a bit more time to address liquidity issues and so forth. And they have also indicated that the Div 296 GIC rate is actually about 4% lower than the standard GIC rate that sits in the Tax Administration Act. So it's 3% plus the base rate. So it's looking more like what you'd see in a commercial loan environment, what you get from a bank ordinarily, as opposed to that much higher rate that comes with GIC. Now, I said originally that the individual here is the one that is assessed on that liability. So they would be the one that could either A, pay the tax themselves, or B, they would go through the release authority process that we also see in the context of Division 293. So we would probably see the lion's share of people looking at the release from their superannuation fund. And if they do that, then there is scope and flexibility about how that money is to be withdrawn as well. And in particular, if people have multiple interests within either the one fund or across multiple funds, they do have that choice around where they might take that money from. So there is then some strategic considerations from an estate planning point of view there as well. So they're probably the main things for me around that Division 296. There is a fair bit of water still to go under the bridge. We have literally just closed that consultation period. You will have seen in some of the media in the industry, some of the submissions that have been made and the concerns. So whether we do hear that or not, we're just going to kind of need to wait and see. Now, from Smarter SMSF's point of view, we've spent a lot of time recently working on an updated platform, including a number of forms that we've been updating, and they're being reflected across the site at the moment. We've got a number of our members working through a closed beta stage at this point in time. One of the things, I think, Jeevan, you might have mentioned it in the last update, there is some enhanced API for us around deed upgrades. So we are working through that at the moment. So that's where you'll get the ability to be able to grab that information out of Simple Fund 360 about the history as part of the population of the form. But importantly, you'll be able to then post that information if you've completed that deed upgrade with Smarter SMSF. You'll be able to send that back in and automatically update Simple Fund as part of that process. We have made a number of changes to our SMSF Essentials course. Some of you may recognize that as our old SMSF Foundations course. So we have recut and rebranded that. Why? Because we are building a different SMSF Foundations course, so much more beginner level, around 10 hours of content, focused on a starter sort of audience and staff member that might need to just get themselves up to speed with the basics around self-managed super funds. We are releasing that over the next month or so as well. And again, once we've finalized that, that will also be available from within the BGL Learning Channel, in addition to the Smarter SMSF site. And the last thing I just wanted to note for everyone, we do have our next live virtual masterclass coming up. We are looking at the topic of contributions. So we have a case study. We work through this case study across all of these masterclasses, and to help you identify and unpack a range of issues on contributions, whether it's small business CGT cap amounts, in specie transfers, the implications around NALI with those contributions, downsizes, and much, much more. It is very hands-on in terms of the way it works. We provide additional materials, flowcharts, answer booklets, and the like. So if you are interested in registering for that event, whether the live event or the recording, we do have that coupon code you can use there, BGLMC50. That'll take $50 plus GST off that standard price. And again, you can jump on the website to find out more. That's it from me, Jeevan. So if anyone does want to look at registering, you can do that from within Simple Fund 360 or jump on the Smarter SMSF site and you'll be able to get registered and get yourself underway. I'm going to hand back to you, mate.
Well, thanks, Aaron. And also in terms of events, myself and Andrew Pascoe, if anyone who's Melbourne-based, we are running a discovery of Simple Invest 360. So really what is Simple Invest 360 over breakfast on November the 1st. So I'll get our marketing team to include the details in the email which is sent out. That being said, if you are based in another city and say this would be fantastic to have in our city, please reply to that email and say we'd love to see it in X city, and we can definitely look to sort of organize that in the future there as well. Questions. So maybe Aaron, while you're on the topic there, so I think there was two there. One was around, I guess, opening TSB, and what does it account for? Is it just the opening balances, or is there more to it?
There is more to it. So I think ordinarily most of us kind of look to the SMSF annual return and the member information and go, well, whatever we actually have within BGL and produce the account balance would be the amount that we also include within our TSB. So that can be right, but there can also be circumstances where that value can be different. And the reason why it can be different is because total superannuation balance, when we look at how it's defined, and this TSB value concept is still really looking at it in the same guise, and that is that it's the termination value. So then you say, well, what is termination value, Aaron? Well, it's the value as if that person was to cease an interest in that fund at that point in time. So if you have assets within the fund that have a significant capital gain, and that is currently unrealized, and you haven't yet sold that, well, do you have things like tax provisions, so a provision for deferred income tax, actually built into the calculations that you run in Simple Fund 360, i.e. is tax effect accounting on or is it off? You may also have commercial property or other property inside the fund that there are additional transaction costs that would be incurred as part of the disposal of that particular asset. So again, the rules around that termination value for TSB allow you to account for that for the purposes of that label within the member information. So that may be relevant in some circumstances, it may not. In the context of this $3 million threshold, I think it's going to be absolutely relevant. And therefore, you wouldn't necessarily be making a change to the member information around the account balance, because that's what you have within the accounts ordinarily. But you would be looking at a work paper that would be supporting the TSB value calculation that sits below the account balance in that member information there as well. So There are some nuances to it. It's not only applies in the context of the $3 million stuff, but can also apply when we think about how TSB impacts a range of other measures. Well, we could be looking at that as a different value for the purposes of non-concessionals, catch-up concessional contributions, disregarded small fund assets, the list goes on.
Cool. Another one there, which from Phil, do we know if our politicians, public servants and other members of defined benefit funds will be subject to Div 296?
The short answer is some will and some won't. So things like constitutionally protected funds, judges and those sort of things won't be subject to these rules. But when you kind of go outside of that, there are others that will be included. So there is a section within the rules. So I've got just the explanatory memorandum here, but it does talk about these defined benefit interests and so forth. So yes, there will be some politicians around those DB pensions that would naturally be impacted by this. How some of this works, we've got some reference in there. There are, I should say, a number of regulations that we don't know about yet and how they will apply. So until we kind of see a little bit more meat on the bone, we won't know broadly how some of these elements will operate, but there are naturally defined benefit pensions getting incorporated into this.
There was a question there about within Simple Fund 360 finding members which are over $3 million in the current stage. So we do have a filter. So down below here, total super balance as at 30th of June 22. So it's running there at 2 at that stage. So you can go through and select a particular filter you like. So I'll select this one, 2.7 to 3 mil. And then within that, you can actually do that however you like. So you could say, okay, you want everyone, you want basically anyone over 2.5 million and find that. You'll get that particular list and then you can export that list out so you know which funds and members are potentially affected. We'll be updating this to obviously 2023 pretty soon as well. But that's obviously the current way to get that in bulk, you know, across the board there.
Yep.
Cool. Something like have you looked at the implications of paying tax out of super versus personally? So I'm assuming that's the same as, well, it's probably no different Div 293, wouldn't it be? I don't know.
Yeah. So I think the reality here is there are going to be a number of clients that are going to have to understand whether they take any action inside the fund, and that is, you know, holding those assets outside of the superannuation environment versus the SMSF environment. So yeah, a lot of this is going to be based upon individuals' own circumstances because, you know, what level of other income do they have outside of superannuation currently? Are those assets potentially being counted for other aspects? You know, if we think about things like Commonwealth Seniors Health Card and these, the fact that prior to 1 January 2015, those amounts are not being included in the context of the definition of income. So therefore, there's no, I guess, hard and fast rule here. Quite clearly, you're going to need to look at some calculations in respect to an individual's circumstances and therefore make that assessment themselves. So I think it's not, it's not kind of chuck the baby out with the bathwater here and make those changes just to get it down, because, as I said, there might be circumstances where the individual's personal position is much worse outside of the SMSF or superannuation environment, and therefore, thinking about how the fund might be investing and the fact that they might be in a refund position from the income tax point of view with franking credits. Well, yes, they might not be getting the franking credit refund, or they will be getting a franking credit refund, but they might be giving some of it back in a Div 296 perspective because they would then be releasing amounts from their fund. But that might be the right happy medium here for that particular client. I think for those of you that have clients in this space, there's naturally going to be some important conversations about how these laws are going to work. over the next 18 months or so before they are intended to come into effect.
There was a question of switching now into workflow. So question about which cloud-based practice management systems will we integrate with first. So we're happy to integrate with everyone, but I dare say the ones we would target first are the ones we're currently doing our sort of client contact-based integration with at the moment. So if we go across here, sorry, into practice management settings, at the moment we do have this ability to, with Zero Practice Manager, MYB Practice Management, which is the former GreatSoft, and we're about to release APS as well. So I dare say those three we will target first, but we're open to integrating with any providers really on that basis. We also had the question around Simple Invest, about being able to export the trust tax return and company tax return out of BGL into zero tax like we do for SMSFs. I think as Andrew mentioned, we are waiting on Xero to allow us to do this. It's not something they currently allow as part of their API and integration there at the moment.
So Jeevan, as what Eleanor just said, it's more the question that she was asking is more around the where should you pay it? So should you pay it in or out of the fund? Again, I guess that I haven't done any sort of analysis on that, but interestingly, if you've got different pensions that are being paid from within the fund with different taxable components, naturally those with the higher taxable component would be one that you would potentially look to be targeting to be making that withdrawal, because you'll then be reducing that potential estate tax issue that would be made on that taxable component.
A question there from Katie: when does Div 296 start? I guess at the moment.
So if these laws do come into effect, it does start on the 1st of July 2025, so the 25-26 year. So Labor were it's kind of, if you think about this with the stage 3 tax cuts, so we did see the coalition government get those legislated. So even when Labor was appointed, these in essence had already become law. So there was a requirement for Labor. They would need to make an amendment to the law to reverse those laws. And therefore, this is what Labor is intending on doing here. We will see another election before the commencement of these measures, but in essence, it's Labor's view to try and get these embedded and locked away so that they do then apply for the 25-26 financial year.
So Katie just asked about the exporting the tax return to zero. So yes, so for SMSF, so if I jump back into here, just make sure I read the question correctly. Yep. So for SMSFs, when you prepare the tax return, there is once it's actually validated, there is a button here for Xero Connect where we're able to push the entire SMSF annual return into Xero Tax, and you're able to lodge that within Xero Tax. So we do support this for SMSFs, and we're waiting on Xero to allow us to do the same for trust tax returns and company tax returns there as well. Like always, a copy of today's recording, if it's needed, will be emailed to everybody. We'll make sure we'll email the code and everything for Aaron's masterclass there as well. And if you do have any questions post-webinar, please let us know. You can simply just reply to the email or grab my details. So thank you, everyone, and have a great day.